I'm Thomas Moore, manager of the Aberdeen Equity Income Trust. The UK equity market has been troubled in recent years, mainly for macro reasons. The UK has been out of favour with asset allocators, and as a result, there's been significant outflows. This has put downward pressure on valuations. Now, we believe that the current setup is positive for UK equities. And the key reason for that is that valuations have been driven down to such an attractive level relative to the global peers. Now, when you look at UK valuations against those global peers, they just look out of kilter. And that is attracting a significant interest from bidders. So we're seeing M&A activity picking up. We've had 3 of our companies subject to M&A over the last month, which is quite interesting. DS Smith, Anglo American, and Timon. And we're also seeing a very high level of share buybacks. Now, as a reminder, buybacks are used by management teams really to reduce the number of shares in issue. And if you are growing your earnings at the same time as you're shrinking the number of shares, hey presto, you've got a higher earnings per share, which is normally good news for share prices. So the combination of increased interest in UK companies from bidders internationally and an increased level of share buybacks, we've got 18 of our companies currently in the midst of a buyback program. That is a high percentage of the portfolio that is seeing buybacks. And we think that combination of M&A and buybacks should underpin the portfolio from here. One company that is in the midst of an M&A situation at the moment is DS Smith. This company initially had a bid from rival paper and packaging group Mondi, and then the subsequent bid came through from International Paper. Now, DS Smith is a well-managed business. It's got some great assets here in the UK, in Europe, in North America. And it's one of those industries where you can easily compare valuations across different markets. And what really stands out is the valuation of DS Smith was low relative to its global peers. And you have to say that must reflect the discount that the asset allocators are applying to UK assets. Now, of course, that is causing this period of de-equitization, where we're seeing that companies listed here in the UK are increasingly under the spotlight. Now, we saw that as an opportunity last summer, building a position in DS Smith during the summer months at levels around £3 per share and below. And more recently, the shares have moved ahead thanks to this M&A activity. There are some industries where the UK really excels, and one of them is financials. Now, of course, most people, when they think about financials, think about the big banks, and we certainly have a range of highly cash generative banks, both here in the UK that operate domestically and also the Asian banks, Standard Chartered and HSBC. We own a range of these large banks, and they're seeing significant increases at the moment in net interest income, which is really thanks to the huge gap that they're able to exploit between what they pay depositors on their current accounts and what they're able to lend at on mortgages and other loans. So that's a really attractive sector in itself. But of course, being index agnostic as we are at the Aberdeen Equity Income Trust, we can look way beyond these large cap stocks. And we're looking also down in the mid caps, down in the small caps. We're looking at opportunities that we see where the market's really just lost interest and it's ignoring some perfectly good companies with really strong prospects. I'll mention a couple now, what we've been adding to over the past couple of years. So one would be CMC Markets. Now, CMC Markets is a CFD platform. They do spread betting and CFDs here in the UK, but also they've got a leading market position in Australia and in Asia. So CMC troughed around about October, November last year. And at that level, it was trading around the level of cash that was sitting on its balance sheet. Now, we think that really was an opportunity. We started to buy at the end of last year. And subsequently, that company is seeing significant upgrades, both thanks to higher revenues from trading activity, but also from a cost program. And of course, the great thing about focusing on valuation is that you always have a margin of safety. And if you know that the stock was trading around cash, you know that there was a margin of safety that you could exploit. And actually, you could just sit there waiting for trading to pick up, which it duly did. The other financial I would mention down in the small and mid-cap end of the market is TP ICAP. This was the merger between Tullett Prebon and ICAP, and it's the world's largest inter-dealer broker. Now, TP ICAP is known for dealing, particularly in fixed income, but also in commodities and other asset classes. But what people don't necessarily understand about TP ICAP is that all of that trading activity delivers data that they can market. Now, if you think about how successful companies like the London Stock Exchange have been in selling data, then you think that TP ICAP is the largest interdealer broker in fixed income, which is itself a massive asset class. Think of all that data and how much that could be worth. And they are now looking to list their data business called Parameter separately. And the market capitalization that the stock market is likely to place on that could be very large indeed, and quite a big percentage of the current market cap of that stock. Again, these are stocks that are under the radar. They're not being properly analysed by investors or brokers. And so we see those as real opportunities. One of the questions we're asked is, why is there such a big discount to net asset value for the big banks? Now, surely there's something wrong with the banks. And we would refer people back to all the regulatory events that have happened in the last 10 years. Of course, these regulatory events can be a shock initially, and investors have long memories. So if you think back to the payment protection insurance scandal that hit the big banks, that happened and it lasted for years. Now, people have still got in their minds these memories of such regulatory events. But at the same time, if you look at how much cash these banks are now producing, they're able to do big buybacks alongside their very attractive dividends. And of course, the combination of that means that their net asset value per share is growing from year to year. That wasn't the case 10 years ago. And at the same time, they're doing buybacks. That's just shrinking the number of shares in issue. They're doing dividends. So altogether, that makes an attractive investment proposition. And of course, there is still the case that regulatory events can still happen. We've got one at the moment, which is motor finance review by the FCA. But we have to take a cool head to those situations, work out how much value destruction is being priced in, and then have a look at the share price and see whether that's already reflected. But we just look at the income characteristics of the financial sector and we see that as too compelling to ignore. Geopolitics has been a key feature of investment markets over the past 2 years. Initially, Russia's invasion of Ukraine, and more recently, events in the Middle East. Now, what we're seeing is both supply tightening as a result of these events, and the impact that has on countries is that they want to make sure that they are independent in terms of their supply of energy. That's a positive for many of the companies that we own in Aberdeen Equity Income Trust. And at the same time, if you look at demand, what we're now seeing is some easing in concerns over the risk of a hard landing. And of course, when you look at commodity prices, we're talking about supply tightening, we're also talking about easing concerns on demand. That's an interesting combination. And whilst it's always uncomfortable to see geopolitics unfold in the way in which it's currently unfolding, we are seeing both tightening supply and increasing demand as a positive for this sector. Every now and then we find a company that has both the stock specifics and the macro on its side. And one such example is the gold company Centamin, which we own in Aberdeen Equity Income Trust. Now, the beauty of Centamin is that it was already improving. The production of their key mine in Egypt, Sukari, had been improving under the new management team, who've been working hard on productivity over the past 3 years. They've done a lot of work and there have been some bumps in the road, but that is finally coming through and they're getting towards their target of 500,000 ounces per year. Now, on top of that stock-specific story, we're also seeing a surge in demand for gold right across the world. Interesting to see central banks buying gold, individuals are buying gold. So there's an increase in demand for gold, and that's partly linked to the difficult geopolitics around the world. Now, if you put those two things together, you've got quite the recipe for the share price. And the market is now beginning to put a price, not just on Sukari, but also operations elsewhere in the world, which Sentiment own. For example, they have operations in West Africa. The market had pretty much written off that particular mine not so long ago. And the market is now beginning to say, well, look, that could be worth something in this current feverish geopolitical backdrop, which is giving options to the management team. So we do see a name like Sentiment as a really good source of diversification for the portfolio at a time of uncertain geopolitics. Thanks for your attention. And for more information, please visit our website, which is on the screen.